Hello, and welcome to Portfolio Matters, weekly markets checklist, week 139. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Before we get going, a couple of housekeeping items. So we will be having a monthly Discord chat with Rogue Trader on Thursday, the 7th of December. Please put it in your diaries. And a reminder that we're having Christmas drinks 2 days earlier on the 5th December. We've yet to work out a venue. We'll put our minds to it.
Can I just go on, Keith? You're the second one from the right to look at it, aren't you? And your beard doesn't look really particularly substantive.
Yeah, I should try and do better for the drinks, Richard.
Thank you.
Right, on to the news. So we have a packed program this week because obviously we didn't record last week. So there's 2 weeks worth of macroeconomic data to get through. But the news, well, over the last couple of weeks, we had weak inflation numbers in the US and UK, and that sparked an enormous equity and bond rally. The equity rally has lasted. The bond rally, I'm afraid, has faded. And that leaves the S&P 500 and the NASDAQ close to their highs for the year. Absolutely extraordinary. The traditional end-of-year rally is very much happening. Now, the big news in the UK, which we will go through, is the autumn statement, which included a 2p cut in national insurance and led to a big sell-off in gilts. The government has essentially spent most of the improvement in the UK public finances since March in one go. And the market had been expecting that the improvement in the UK public finances would lead to falls in public borrowing. Well, now that the government spent all that improvement, that ain't going to happen. So gilt sold off. The US government has passed a bill to fund itself to avoid shutdown. So that fear is now over. The German Constitutional Court has affirmed its hard black budget balance rule that limits the fiscal deficit to 0.35%. In essence, it ruled that leftover funds from the pandemic could not be used for other purposes, and that is going to complicate the various EU budget negotiations. And the Germans are not going to be doing any fiscal stimulus, basically. In Argentina, the Argentinian economic train wreck has just appointed a new driver who has big plans to really cut the size of the government. In the 19th century, late 19th century, Argentina was one of the richest countries in the world. And since then, bad economics has turned it into a basket case. Let's see what the libertarian Javier Milei does. I suspect he won't be able to change much, and chaos will ensue. Now, Andrew Bailey, the Bank of England governor, has warned that further interest rates rises may be required in the UK to tame inflation. The markets were skeptical and largely ignored him. And finally, the last of the Magnificent Seven, Nvidia, announced its Q3 earnings, and it beat on earnings and revenues. The shares fell. So this is the market's expectations for US interest rates, and you can see they are expecting cuts to come as soon as the start of Q2 next year. Shall see. I think you need to see some substantial deterioration in the US economy for that to be true. And this is the Argentinian peso. You will remember that it was pegged to the US dollar 1-to-1. Is that 2002? Since then, it has fallen to around 400. Actually, and this is the official exchange rate. The unofficial exchange rate is around 800. So the deterioration in the value of the peso in your pocket has been absolutely extraordinary, and just goes to show what happens when governments print money irresponsibly. This is the unofficial exchange rate, running around 800. Oil prices have had a turbulent couple of years, but actually are right back to where they were. We talked earlier about how the German Constitutional Court has reaffirmed its hard black fiscal balance rule. Well, this is actually German infrastructure investment. And you can see they haven't been doing any. So is there fiscal rectitude having actually negative economic consequences? And does that mean it's actually a false economy? Because if you neglect your infrastructure, surely you just have to spend more in the future. And finally, Nvidia. This is their revenues, and 2023 has been absolutely extraordinary. Let's see what happens as their competitors start to launch chips. Okay, and on to this week's economic data. The UK, Richard.
Thank you, Keith. So UK CPI month on month, better than expectations, and down to 0 in October from 0.5% in September.
Yeah. Actually, so I've just put in these figures on the chart because in February, from February to is that May this year, we had a big chunk of inflation. Yeah. And if you look at annual inflation, we are not going to get inflation down to anywhere near target until June next year, when these figures fall out.
Interesting. And the year-on-year CPI continuing its rapid fall back down.
Yeah, no, really impressive, actually. The speed with which inflation has fallen, it's substantially faster than anyone was expecting earlier in the year.
And UK food inflation also falling. Obviously went up significantly higher than CPI, but it's coming back down. It's still significantly higher, double CPI. And it's still 10%, which is very, very high.
Yeah.
The big contributors to the changes, household services, housing and household services, big drop there. And then we can see food and non-alcoholic beverages was the next biggest drop. What's going up? Owner-occupied housing and recreation and culture. This is the core CPI for the last 10 years, broken down into goods, services, and CPI excluding energy, food, alcohol, tobacco. And you can see actually they tend to move, as you would expect, quite closely together. But the big one of late has been this goods.
Yeah.
Goods, about 15%.
The fall in goods inflation has been great, but that service line, which is hardly moved, that looks worrying. That looks like persistent inflation, despite the big falls in headline CPI.
Yeah. Core CPI month on month was 0.3%, again better than the expectations and down from 0.5%. But as Keith pointed out, that big lump in February to May isn't going to fall out for another 9 months, 7 months, whatever.
Yeah. Never do mental maths live.
No, it's not 9.
And also it means, this minus 0.9% in January. That means that next January we're going to see a, bounce. Yeah.
Mm-hmm. And year-on-year core CPI. So year-on-year is really taking into account the recent falls. And year-on-year, it's looking stuck at 6%.
It's going to come down, but not fast, sadly.
Yeah. And RPI was actually negative month on month in October, and that RPI 2 is falling fast. But notice it's still 6%.
Yeah. But again, the trouble with using these yearly numbers is they're really affected by inflation earlier in the year. But if we go back to core CPI month on month, over the last 5 months, that is still annualized at around 3.8%. It's still too high. This month, 0.3%, everyone jumping up and down thinking it's great. That's still annualized at 3.6%.
So what is this chart showing us, Keith?
Well, this is a chart from the weekly back in April, and it shows what the market expectations were for RPI for the coming year. And we've just had RPI for October, and it came in at 6.1%. So that is 10% lower, if you think about it, than the 6.8% the market was then expecting back in April. So inflation has very much come down faster than we were expecting.
Can I just put in a plug here, because it's all thanks to Rishi Sunak?
I think you're the only person in the country who would be thinking that, Richard.
UK PPI input year on year is negative. Has fallen negative now. September's has been actually adjusted up, wasn't it? But October, 0.6%. So that's augurs well for future inflation as well.
Yeah. Well, we've had this debate about whether the PPI leads CPI. We think it may lead by 1 month. Not sure.
Yeah. And output PPI year on year is effectively it's a 0%. UK unemployment rate was stable at 4.2% for September. So there is no great sign of staff being laid off as a result of a slowdown in the economy.
Yeah, it is a big rise from its lows, but there's so many question marks over the reliability of UK data at the moment.
I think they're having to reinvent it, aren't they? Because it's shown to be completely unreliable. UK wage growth 8%, which is not consistent with the underlying rates of fall in the rate of inflation we're seeing. At some point, this wage growth, if it continues, is going to start forcing the rate of inflation, general CPI up. UK median monthly pay was up 6% nearly in October year on year, according to PAYE data. So it's falling, but it's pretty high. So what's this chart showing us, Keith?
So I've downloaded the actual pay data from the ONS, and this is the absolute numbers of, I think it's weekly pay, total pay and regular pay, so excluding bonuses. And if you annualize the change in pay over the last 3 months, so ignoring the big rises earlier in the year, then the change in total pay is only 1.8% annualized, but that is peak to peak, essentially. Regular pay is running at 4.6% annualized, still too high.
The health and social work sector has been the biggest increase in payroll employees for the last year. And you can see that it is plus 220,000 employees, and dwarfs pretty much everything else.
Yeah.
The next highest is education, which again is public sector. So effectively, not all health and social work is public sector, but a large chunk of it is. So effectively, a lot of new employment is from the public sector. And this chimes actually with something that I was listening to the other day, which is and particularly actually relevant to the US, which you've got sort of two economies going. You've got the public sector economy and you've got the private sector economy. And public sector economy currently, both in the UK and the US, seems to be immune to economic pressure because governments are continuing to fund it. and the private sector is having to take the strain. And you can see the private sector is taking the strain here.
Yeah, well, we'll discuss this further when we talk about the autumn statement, Richard.
Yeah. And the UK claimant count in October, an increase in 18,000, which in context of the total number of people employed is an error bar, I would
suggest. Absolutely. And they revised down the September number.
Yeah.
So the bottom line is the UK labour market is slowing, but very, very slowly.
Yeah. And UK HMRC payrolls suggesting a slight increase in employed people. And UK business confidence fell in Q3, so it's had 3 consecutive quarters of falling. But it's not at a particularly low level.
Yeah, I agree.
Capital spending, research and development spending are at quite a low level, and that's not healthy for the future of the economy.
Yeah. But not disastrous either.
No.
These are not big, drops.
Yeah, but if you want to be a knowledge-based economy, as the UK does, really be investing more. So a lot of firms, 40% firms, are expecting their to raise their prices, and that's not good news for prospects of inflation.
Yeah.
UK retail sales month on month fell. They were revised down in September. They fell in October, which is suggestive of a slowdown in the consumer-driven economy.
Yeah.
And excluding vehicles, it also fell, although not as much. Year-on-year retail sales continuing to be below zero year-on-year, as they have been now for the last nearly 2 years. So, and there we show actually quite a big sort of value of retail sales diverging completely from the volume. That's because of the inflation that we've got.
Yeah.
So people appear to be spending about the same, well, they're actually spending more money, but what they're actually buying is less, as I know from the tins of tuna fish that we buy.
Yes, absolutely. I'd like to see this chart for Argentina.
The UK PSBR is comfortably below zero, as ever.
Yeah. You see, so for October, that is one of the highest October borrowing requirements on record. And then Jeremy Hunt comes out and he increases government spending. How does that work?
Yeah, well, it works for him as a politician, doesn't it? Because he wants to be re-elected.
Yeah.
UK Labour productivity is it's inching up very, very slowly, isn't it? Much too slow. One of the issues with the economy, of course, that productivity growth is too slow, and Q3 productivity growth was negative.
Yeah, absolutely. So in order to grow the economy, that means you need to throw money or more capital at it, and capital is currently expensive. So
it's interesting. So you look at COVID. So you look at from when it started, which is 1997. The growth rate is relatively healthy, I guess. Then you've got the GFC, but then it picks up and it's almost the same growth rate. Then you have COVID and it picks up to where it was and it plateaus. So COVID has been really bad for the UK economy.
Yeah. Actually, well, the GFC has been very bad for the UK economy. Output per worker since the GFC has been very flat. Yes, it has.
So I was looking at the gross value added line at the top line, but the output per worker has been dreadful, hasn't it?
Yeah, and basically we've grown the economy by adding people or hours worked.
Yeah. UK CBI industrial trends orders looking pretty sick.
Yeah.
And the UK global manufacturing PMI actually looking a bit less sick this month, although generally the trend is not very good. And it hasn't broken that trend yet. And the UK global services PMI is fairly, it's at 50, isn't it? And it's unremarkable, I think.
Well, it's ticked up quite substantially, actually. So just back into, well, I say
Yeah.
substantially, it's ticked back into expansion territory
Yes.
briefly.
Yes. And the composite, which is the sum of the two, is just below 50, actually just above 50. And of course, services is a big chunk of the UK economy, so that outweighs the effect of the manufacturing.
So I was puzzled by these numbers, given that we know that UK economy doesn't seem to be doing all that well. So how come it's bounced? Well, if you read the commentary on from S&P Platts Global, who produce these PMIs, the commentary was that new orders continued to decrease, though at a slower pace, and activity was boosted by increased work on order backlogs, and order backlogs fell by their largest amount since August. So the question is whether this is sustainable. If new orders are continuing to fall, that suggests at some stage you run out of backlog.
Backlog clears, absolutely. Interesting. And the UK Consumer Confidence Index is bouncing around minus 25, I would say. And so it is poor.
Yeah, not great, but, better than it has been.
Yeah. So the ONS estimated that the UK had net immigration of a record 745,000 in 2023, which is a real problem for Rishi Sunak. One of his 5 promises, wasn't it, was to do something significant with this number, which he hasn't succeeded in doing. And 39% of non-EU immigrants came to study, which suggests that in theory, they should be temporary.
Yeah. But that's just an amazingly large number, 745,000.
Yeah.
No wonder we've got accommodation difficulties.
I know. It doesn't really. I don't think it matters what your political viewpoint is here. The society can't actually sustain that rate of increase. It's just extraordinary.
Yeah.
It is, and I know there is. There's no control over it. It appears to be impossible for government to gain a grip on it.
Exactly, and having done Brexit in part to control immigration, well, we ain't.
No. So there we have the summary, which you might want to just read through, and we'll move on to the next section.
Thank you, Richard. On to the EU. So, EU CPI, this is the final estimate, came in on expectations at 0.1% month on month. Very little inflation in October in the EU. And the great news was that it was very broad-based. The mass of inflation components in the EU is slowing. Year on year, down to 2.9%. Actually, rapidly approaching the 2% target. The trouble is, core is not. So core is still at 4.2%, coming down, but the ECB is not going to be cutting rates until that gets closer to 2%. And that seems actually quite a long way off yet. So this is EU employment change in Q3, and employment continued to grow. So if in order to get inflation under control, you need to create some slack in the labor market. Well, it doesn't look sustainable yet. Q3 GDP in the EU was negative, down minus 0.1%, and Q4 GDP is unlikely to be better. Therefore, the EU is probably already in recession. Year on year, grew by 0.1% in the year to Q3. Industrial production in September fell 1.1%, slightly missing expectations. And year on year was a pretty dreadful minus 6.9%. So it's amazing that year on year, the GDP growth is not worse than it is, given the big fall in industrial production. Construction output also fell to negative in September. And we know that the German construction industry is in particularly bad shape, and that new orders for construction have fallen very sharply. So that number is likely to continue getting worse in the coming months. The ZEW Economic Sentiment Index, which is a survey of economists, show economists actually are becoming much more positive on the EU economy. So that massively beat expectations, coming at 13.8 in November, well above expectations and well up on October. Consumer confidence also ticked up, but remained pretty poor. Now, we also had PMIs for the Eurozone, and they were a bit better, but still pretty dreadful. So this is the manufacturing PMI, which is 43.8, up on October, but still awful. Services PMI, 48.2, slightly up on October, but still negative. And that left the composite at 47.1, which was up on October and slightly better than expectations, but still firmly in recession territory. The economic surprise index for the Eurozone is actually recovering decently. So economic data in the Eurozone is still missing expectations, but by less. So fewer of it is missing expectations. So is the Eurozone economy approaching a bottom? I don't think it can be, as the lagged effect of interest rates rises continues to be felt.
And also, I think German manufacturing is in real trouble.
Yeah. So, in summary, pause, take a look. Inflation is falling, and the Eurozone is probably already in recession, and we think it's likely to continue as the lagged effect of interest rate rises still affects the economy and increasingly affects it over the coming months. On to the US, Richard.
Thanks, Keith. So US inflation month on month was 0, and some very good news for the US. And year on year, it is around about 3.2%, and that fell, but it hasn't. For the last couple of months, it hasn't fallen below that low point.
Yeah.
So is it stuck? Question mark. US core inflation month on month at 0.2%, which was better than expected.
Yeah.
And annualizes at around about 3%, I think. And core inflation year on year was 4%, so slightly down on September. Still falling fast.
But the US has got exactly the same problem as the rest of the world. There's this chunk of data, of high inflation data from earlier in the year, and until that falls out, you're not going to get inflation, the annualized number, down. So the annual number down.
Yeah. This is a graph of the month-on-month print in US CPI, showing the main constituents of the moves. And so the fall was mainly due to energy, and the things that went up were core services.
Yeah, actually, I thought this was really reassuring in that. So, we got to 0 because of negative energy. But goods inflation was also negative, and food inflation was, negligible. It's all services. Service inflation is coming down, but not enough yet.
With core services, CPI fell month on month, but was still at 0.23%.
Yeah, annualized, that's too high.
And super core inflation is 3.7 and is it's not really falling at the moment, is it? Super core, it seems to have sort of stabilized.
Yeah.
CPI shelter continues to exaggerate CPI because it's such a lagging indicator. PPI, US PPI year on year at 1.3%, considerably better than expectations. And core PPI year on year at 2.4%, and that's considerably better than expectations as well. And the US PPI is weak, and it looks like it possibly leads CPI by a month, which suggests that CPI may continue to fall next month.
Yeah, this is the debate we've had. Whether it's contemporaneous or PPI leads in any way.
Yeah,
I'm just not sure.
no, it's difficult to tell, isn't it? Industrial production month on month was down 0.6%, which is worse than expectation.
That's in October.
Yeah. And the year on year was down 0.7%.
Yeah, notice how there's not a good number, but in Europe, that's minus 6.9%. The
Yeah.
US has done so much better than
Yeah.
Europe has.
US manufacturing production month on month down 0.7%, which is and considerably worse than was expected. These numbers are I think they're quite lumpy, aren't they? If you go back to January, it's up, down,
Yeah,
up, down, up, down.
that's true.
It's hard to discern a trend from that data. And year on year, manufacturing is down 1.7% in October. And it does look like it is going to fall further. So US durable goods orders month on month, it doesn't look a particularly healthy chart at all, down 5.4% against consensus expectations, 3.1. And durable goods orders ex transport month on month was 0. Consumer sentiment is actually slowly climbing. It's quite a noisy chart, this, but it is on a little bit of an uptrend at the moment.
Well, the November number was, substantially below expectations. Is it turning back down again?
Yeah, I mean, that's the question, isn't it, Keith? Is that just one of the noisy spikes and it's then going to get bounced back up towards 80, or has it changed?
Actually, you know what? I think it's going to bounce because I think these numbers came out before the big rise in the Nasdaq.
Yeah. And the Michigan consumer expectations basically showing the same thing. And consumer current conditions actually looks very much like the expectations chart.
Yeah.
1 year inflation expectations have actually spiked up, and it looks like quite a chunky spike up. So we'll have to see whether that falls back down or whether it's a change of direction.
It's mystifying. Why is that happening when inflation's actually coming back down and the economy seems to be slowing? Odd.
Yeah. What are people seeing? 5-year inflation expectations also jumped because this feeds through into pay rise expectations.
Yeah.
New York Fed Empire State Manufacturing Index, very, very noisy, much noisier in the last year or so than previously.
Good point, Richard. Yeah.
Yeah, difficult to tell what it's doing at the moment.
Yeah, but it's saying that November saw a bounce. We know, from previously the industrial production numbers for October. October was a poor month. And so in the New York area, at least, November, it's bounced back.
I'm not so spiky. It's hard to tell. And the US Philadelphia Manufacturing Index is this data is really hard to interpret in the short.
Well, I think you basically just saying that what it's saying is there has been a little bounce back in November, but not great.
Yeah. So, and the Kansas Fed Manufacturing Index, it is where it is. I don't know what I'm not quite sure what it's telling us.
Yeah, well, I'm just think that all three of them are consistent in saying that there was a bit of a bounce back in manufacturing in November.
Yeah. And future activity component of the New York Fed's Empire State Manufacturing Index is continuing to fall sharply. What's the future activity component, Keith?
Well, it's these headline number is made up of various subcomponents, and the trouble with all these PMIs, like the UK one, the PMI bounced, but then the new orders component, which frankly to me would be the most important part, continued to fall. And what it's saying is, what this chart is saying is exactly the same things happening with the US manufacturing PMI. Yes, it's bounced, but actually the future activity component continues to fall. So that suggests the bounce in the PMIs of the New York Fed's Empire State Manufacturing Index, in this case, is likely to be unsustainable.
Yeah. US Fed Business Conditions Index is, again, this is really noisy, but it's not looking fantastic, it has to be said.
Yeah.
US retail sales month on month, slightly down in October.
Yeah. Now, can I just read this out from the FT? How do we, to sum up the message from the macro data and retailers' third quarter reports? We are in a consumer slowdown, but it is a mild one so far, as reflected by the good results of the stronger retail chains. The slowdown is more severe in, but not confined to, the lower end of the income spectrum. Given how strong growth was in the middle of the year, none of this is surprising. The trend in goods prices is generally disinflationary and in spots outright deflationary. All of this is consistent with a soft or softish landing rather than outright recession.
So US retail sales month on month, excluding autos, up a small 0.1%, but still up. So this is US retail sales year on year nominal, which looks reasonably healthy. But when you adjust for inflation, it looks rather unhealthy, and it looks like there should be a grey bar there, and the US is in recession.
Yeah, that's very true, Richard, very true.
So the results from the big US retailers, Target and Home Depot, confirmed the slowdown in retail sales. And US business inventories month on month, 0.4%, so no change. And,
well, up a further 0.4% of the way I interpret it, Richard. So this implies to me that a lot of manufacturing activity is unsustainable because you're building inventories, and at some stage that has to stop. It's not a huge number, but you know.
Yeah, no, I take a point. Yeah. So the US National Association of House Builders Housing Market Index is plumbing the depths again.
Yeah.
The US building permits is chugging along quite nicely.
Yeah. So, you know, again, we've got this contradictory data where they're feeling, you know, shit, but they're actually building more houses and permitting more houses. And that's a decent number, frankly.
Yeah. The US housing starts, though, has rolled over, hasn't it? And that's quite interesting. So it's sort of in hindsight, you can now see that it looks like it's reached a peak and it's gently rolling down.
Yeah. Well, the trouble is that's I mean, by historic standards, that is a decent number.
Yeah, but well, we need a couple more months, really, don't we, Keith? But the interesting thing will be if it starts to head back down towards 1,000 on that scale.
Despite the pickup in both permitting and housing starts in October, the PICTE do this index of US housing activity, and they're showing that it actually fell in October and November. So according to them, the housing market is weakening in the US, although you don't seem to see it in the headline numbers. I'm not sure how they create their index, but, you know.
And US existing home sales looking really sad, I have to say.
Yeah.
US RCM TIPS Economic Optimism Index is actually looking like people are becoming more optimistic, but it's just a very noisy chart again.
Yeah.
And the NFIB Business Optimism Index is a little bit below 100, but it's not extraordinarily low at the moment.
Well, I'd say that is pretty low figure, Richard. That's, you know, apart from post GFC, you know, it's the lowest it's been in.
Right, Keith. Yeah, you're right. Actually, I agree. And the number of small US companies either raising or planning to raise prices, it spiked right up, didn't it? It fell sharply, and now it looks like it might be going up again.
Yeah, certainly it's not falling. You know, the Fed needs it to keep on falling.
And NFIB small business actual sales fell again in October. And that's quite an interesting chart.
Yeah, that's not great, is it?
US Conference Board leading index month on month. So the year on change real GDP is in grey or green or whatever that colour is. And the leading indicator is suggesting that GDP should be falling quite fast soon.
It does. Yeah, no, it's amazing. So the question is whether the blue line will go back up or the grey line will drop. But they should come back together.
Yeah.
Now, historically, the grey line has always fallen to join the blue line. And to be clear, I've been expecting that to happen all year, and it hasn't happened. So
yeah, it looks like the blue line sort of oscillates about the grey line, but when the blue line deviates dramatically, the grey line also moves in that direction.
Yeah. Well, I've been forecasting that all year, Richard, and I've been dead wrong. So,
I'm very Keith. And the conference board leading economic indicator continues to forecast a recession.
Yeah.
With the benefit of hindsight, in 2 years' time, economists may say that the US is already in recession. Who knows?
Yeah, that's true. So this is the components of the conference board leading indicator. And you see that a big component is consumer expectations, which we know have been negative for a long time now. But the other big negative component is new orders. New orders are continuing to fall. And that means that we've talked about this previously. At some stage, you run out of the order backlog, and manufacturing and services have to really start falling. But the other thing is stock prices in October were negative. We know in November they're going to be strongly positive. So is this going to bounce?
Yeah. Decline of the leading index relative to the coincident index remains consistent with a coming recession. So you have the grey bars every time it reaches a sort of nadir, which it is definitely at the moment. There should be a grey bar. So the Chicago Fed National Activity Index hasn't looked good all year, has it? And that's another fairly down month in October. Red Book retail sales actually is looking quite healthy. The 30-year mortgage rate is just pulled back a little bit from being at nearly 8% to more like 7.5%. The mortgage market index looks like it's making no effort at recovery. US initial jobless claims fell. And, from the point of view of the health of the economy, it looks healthy.
Yeah, absolutely. So, the bottom line is that we're not seeing a huge increase in unemployment.
Yeah. Continuing jobless claims, however, is starting to look like some of these unemployed people are sticky.
Yeah. Well, but again, if you asked it 2 weeks ago, you're expecting this to get rapidly heading to 1.9 million.
Yeah. I think if it does go to 1.9 million next week, that would be quite interesting. The Citigroup Economic Surprise Index is actually looking surprisingly healthy. I'm sure I've made that joke many times.
Yeah, no, that's true. But it is less positive. So economists are less surprised by the economic data than they have been, but it remains positive.
Is it true that economists are only surprised when you have negative economic data? So if it's worse than last week, they're surprised. If it's better than this last week, they're not surprised.
You're way ahead of me there, Richard.
Probably way ahead of myself, I think. That's a GDP now forecast, which I have to say, to me, looks like a straight line.
Yeah, I agree. I mean, which shows the US economy is doing just fine. Thank you very much in Q4.
Yeah, I think you're spot on, Keith. And there's a summary. Pause and take a look at that.
And on to China. So Chinese loan growth beat expectations, but that doesn't look particularly strong number to me. But industrial production beat expectations at 4.6% year on year in October. That looks a decent enough number. And retail sales were really good, if you believe the numbers, up 7.6% year on year in October, well ahead of expectations and up on September. Fixed asset investment missed expectations and continued to fall. So if you look at the stats coming out of China, and obviously there's big question marks over their validity, you would think that Chinese economy is actually doing okay and successfully moving away from fixed asset investment towards consumption. Now, this chart shows the birth rate, which is continuing to fall at a really rapid rate. And that suggests China is going to get old before it gets rich. So in summary, China's economy, if you believe the data, seems to be doing just fine. Okay, and onto one chart. And this is a chart of the Magnificent Seven versus the rest of the NASDAQ. The NASDAQ has had a very good year, but if you invested in just the Magnificent Seven, those top tech stocks, you would have doubled your money this year. And obviously, if you didn't have them, as I didn't, and I think Richard did, then you have missed out, because those are basically the only financial assets in the world which have had a really good year. Extraordinary.
Yeah.
And, against a backdrop of rising interest rates, then you'd expect that tech companies, which are growth companies, where all of their earnings comes, they're expected to keep on growing into the future, the discount rate on those future earnings would rise and their current value would fall. And the opposite has happened.
Yeah.
So this week, we've had to get through a lot of economic data. So we're only going to do one special section on the UK autumn statement. So the key announcements. Well, the OBR forecast that the UK's budget outlook had improved from March by 24.6 billion. The Chancellor then announced spending measures which would spend 2/3 of that improvement in the government finances. And his key measures were confirming the pensions triple lock, which we hate on this podcast, the 2p cuts to national insurance, freezing of personal allowances, tax allowances, more on that later. The energy price cap has been extended by 1 year, but at $3,000 a household rather than 2.5. And overall public spending will be frozen until 2025. And the good news for businesses is that capital allowances on investment will be extended indefinitely. That hopefully should lead to more business investment, which will fix our we currently under-invest relative to the rest of the world. And hopefully that may fix it.
I would hope so.
But the bottom line is that he gave away tax while freezing personal allowances. So actually the tax burden will continue to grow over the coming years. And so he's kind of giving away sweeties now, but you're going to be paying for it gradually due to fiscal drag. And the books only balance because of freeze on public sector spending, which will have to be implemented by the incoming government next year. So giveaways today, difficult choices in the future. So we've got some charts now from the Office of Budget Responsibility. The yellow line is their March CPI forecast, and they're expecting inflation to come down very rapidly, much more rapidly than the Bank of England were. And well, now they've changed their tune and they're forecasting that it will come down in line with the Bank of England's forecast, i.e. it will take until 2025 for inflation to hit the 2% target, but it'll come down smoothly over that time. It also has revised up UK's economic performance, and so it now thinks that the UK economy is, 3% larger than it did back in March, thanks to revisions to historic numbers. And it also is forecasting that the UK will escape recession, that GDP growth in 2023 will be 0.6%, and next year it'll be better, 0.7%. Now, if they are wrong, then presumably government finances deteriorate. And what is Jeremy Hunt going to do? We have been forecasting that the UK will not escape recession as the lagged effects of those big interest rate rises start to bite next year. Richard?
Yeah, I mean, I think that the interest rate effect lag is big and has not yet fully bitten. There's definitely a slowdown in consumer expenditure on discretionary items, and I mean, a GDP growth of 0.6%, 0.7% next year. You compare that with record government borrowing, record tax rates, and you say the only way out of this hole is the economy has to grow much faster.
Yeah.
And then the question is, well, how do you make the economy grow much faster? And this isn't the way to do it.
Well, we have added, 700,000 immigrants last year, Richard. We turned the UK into one huge sweatshop and get them all working at sewing machines. Actually, the labour productivity numbers being negative, that's essentially what we're doing.
Yeah, it is indeed. And I completely agree. We need to turn the UK into a knowledge-based powerhouse. Quote Boris Johnson, that visionary leader, and none of anything that any of the politicians have done, apart from say that's what we need to do, lead in any way towards that direction. Jeremy Hunt has actually reduced the R&D tax break for R&D expenditure that you expect. They are frankly clueless, aren't they? And can I just say, you look at so I'm a natural conservative voter, and you look at what's happened. Well, what's happened to law and order in the UK? Well, look at the mess of the Metropolitan Police 13 years on from when the Conservative government was first elected. Look at their competence on economic management. It's appalling. Look at their competence in running the NHS. It's appalling. Everything that they do is incompetent. It's a bit like, where do you go from here?
Well, I tend to agree with you, Richard, as again, I'd say as probably a natural conservative voter. But I'd also say that the conservative government that we have now is just unrecognizable from the sort of one nation Tory parties that, of John Major, because Boris Johnson basically kicked out all the moderates.
Yeah.
And so what you're left with is the incompetent loyalists. I mean, Nadine Dorris, really? Yeah. I mean, it's difficult to imagine her in an intellectual role to which she would be fitted outside of a nursery school, frankly.
So it's a bit like, Nero fiddled while Rome burned, isn't it? It's I find it rather pathetic, actually.
Well, the other thing I'd say, and going back to law and order, is that actually, if you look at the crime statistics, they have been coming down. Now, the perception is, and I very much share in this perception, that, London is just lawless and a medieval city, basically, where, in theory, the police exist, as long as, you never actually try and call on them. Because, when did you actually see one outside policing the major demonstrations? If you get burgled, what's the burglary rate? Clear up rate is about 1%. Exactly. But at the same time, if you look at the crime statistics, crime is definitely coming down. So,
yeah.
Is it a perception problem?
The crime statistics definitely say that crime is coming down. That doesn't necessarily mean the crime statistics are correct.
That is true. Yeah. Because actually, a lot of people have just given up reporting things to police because they know nothing will happen.
What's the point? Yeah.
Yeah. So essentially, the Chancellor spent all of the improvements in the UK budget in 24 and 25. So the white triangles are the change in borrowing between March and November as forecast by the Office of Budget Responsibility before the Chancellor got up to speak. And the black triangles are the change after he got up to speak. So basically, all the improvement in the government finances for the next couple of years, he promptly spent. But the PSBR is still forecast to fall to sustainable levels.
It is, because they are going to continue to, sorry to interrupt you, Keith, because they are continuing to increase the tax burden from a current post-war high to an even higher post-war high in 2028.
Yeah.
Which is not going to improve productivity, which is the only way we can get ourselves out of this mess.
Don't disagree. And that means the net debt will continue to rise. And also, you'll notice this is the net debt figure, excluding gilts held by the Bank of England. And the Bank of England is selling them off. So the total debt held by the public will continue to rise. Now, this is the share of taxes as a percentage of GDP. And Richard is really, really not going to like this chart because it's showing that even after his giveaways, tax giveaways, the share of the tax burden, the tax burden as a percentage of GDP is going to hit a post-war high. So on post-war, we're talking about 1946. So it's going to head towards 38%.
One way of fixing this problem, actually, Keith, would be to introduce performance-based pay for MPs. And basically, if they don't meet certain standards, they don't get paid. And think of the amount of money that would save. 600 people. I mean, there's a few of them that are quite good, but most of them, you could save several £1 million a year on that.
Yeah, well, I think that would just lead to immense manipulation of the statistics, frankly.
Yeah.
So in order to meet its target of reducing the overall UK government debt burden by 28-29, the government has to have a certain headroom in fiscal policy. And so previously, before the budget was announced, the autumn statement was announced, the government had a headroom, a margin of error of about 31 billion by 28-29. Now it's down to 13. So essentially, any small changes in the economic outlook lead to the missing their target. The way we get to balance, to reducing the debt in medium term in 28-29 is by letting taxes go up, but also departmental budgets have been fixed, have been capped. They're not rising. And so as inflation goes up, continues, so in real terms, departmental budgets are falling. And the reality is, when we've done this previously, the results have not been greater efficiency in public services. What's happened is we've done the easy stuff of cutting investment and capital spending. So let's see what happens. The other thing we know is that since the pandemic, the number of UK civil servants has increased by 60,000. How does that work?
Why?
What are they doing? Carrying around Nadine Dorris's handbag. The bond market didn't like it. So this is the yield on the 30-year gilt is up again this morning. You'll see that prior to Jeremy Hunt stepping up to the podium, they were dipping, and now they've risen by 25 basis points. That's an enormous change. Now, that adds about 5 billion to the UK interest bill if all the debt had to be refinanced at the higher rates. Obviously, that's not the case, but certainly the gilt market has not taken it well.
The problem is we are actually in a debt trap, aren't we? We can't raise money sufficient funds in order to be able to move the economy to a much more productive, knowledge-based economy. It needs money. We can't raise that money because the economy has been permitted to stagnate for the last 10 years. COVID came along and vast sums of money were spent on that. and the government commitments are too great. So we are stuck.
Yeah.
And my fear is we're stuck until something breaks.
Immigration, mate. We need to set up some sweatshops in the East End, as you probably have. Can they accommodate 700,000 people? So, our thoughts on the autumn statement. Well, I thought it was poor, frankly, that it was populist, giving away money now, but at the cost of medium-term rises in taxes, and also just fixing the departmental budgets so they're not changing in the next few years, puts essentially the next government, which is very, very likely to be a Labour government, in a bind. So I think it's a very political statement that basically giving away money now and then leaving the incoming Labour government with some hard choices.
Well, my thoughts are, as I've said, we need to significantly cut the overall level of taxation in this economy, and it's really difficult to do it. But that's where we need to go. I just thought the statement was political and not substantive, and I suspect fails to understand the underlying issue. Never mind address it.
Yeah.
They just don't get it.
And having said we're only going to do one section, actually, I'm going to renege on that. And we're going to go through briefly some stats on how the UK public services are doing. So I spent some time going through this report from the Institute of Government, and it's not good, frankly. So this is waiting list lengths in the NHS. So you see, since COVID, they have gone through the roof, and you now have over 3 million people waiting over 18 weeks, and a decent number of people waiting over 52 weeks to get.
The problem with this, Keith, is that, okay, you might say post-COVID that there would be a sudden uptick as people started to be released from their imprisonment, in-house imprisonment, but it's continuing up at the same rate.
Yeah, no, absolutely. I.e., we are failing to keep up with the increase. And, this is a really bad number. People, if you get cancer, then you really have to start treatment within 2 months. And actually, only, 65% of people start cancer treatment within 2 months. And that means you're just storing up problems for later on. This really affects people's health. And routine cases, less than 60% are now getting treated within 18 weeks. And in part, that's the reason we've got problems in the NHS, is that we haven't actually been investing in infrastructure and hospitals and healthcare systems over the last 10 years.
Yeah, and it's just fallen way behind in terms of productivity.
Yeah, and you look at, the number of CT scanners and MRI scanners per capita. Well, we're down with Mexico. Italy has almost 3 times the number of CT scanners per capita than we do. And they've got, 2.5 times the number of MRI scanners. The only reason the NHS is functioning at all is because we have been nicking doctors and medics from around the world, from third world countries. They'll do it for the pay on offer. British people, European people won't do it. So if you go into the hospital these days, you don't see many Brits or native British people. And here's why. Frankly, I thought this was pretty shocking. So this is the real terms change in earnings for NHS staff. No wonder we're not recruiting any junior doctors. We've cut their pay in real terms by 22% of the last decade. And then Jeremy Hunt cuts NI by 2p. Surely you should give the junior doctors a pay rise. I would, anyway.
Jeremy Hunt was health secretary for 6 years, and he was health secretary for a big chunk of where that all went wrong. The man is is, I'm not going to say what the man is because it would be broadcastable.
But,
well,
no wonder you look at this. No wonder the NHS isn't working, frankly.
And the point at which you have that sudden sharp downturn is where the junior doctors' contract was imposed on them. I mean, the whole thing is just a disgrace. And I mean, they are grotesquely incompetent. Yeah. And that to me, that's the issue. I don't know how we get out of this mess because our politicians are grossly incompetent. And that is not actually a party political statement, I suspect.
But actually, good news. Despite all that, we're healthier than we were. So this is people identifying disabled by age. The pink line is 2021. And actually, I think that the reduction in smoking has had a huge effect on public health. So nothing to do with the NHS, I would doubt. But, people are healthier. Elderly people are healthier than they were, substantially healthier. Now, looking at other services, this is also great news. We're sticking far less waste into landfill. That's an enormous drop. Instead, we're burning it, producing power, or recycling it. I personally doubt the recycling bit. What that means is we're shipping off to China for them to deal with the problem. I was personally amazed by this, that police forces have seen big increases in funding in recent years, given the difficulty in actually finding a police officer.
I mean, I think part of the problem with the police is they've been so bound up with, they've got two problems, haven't they? One is that their disciplinary processes and their managerial processes are dreadful. And the other thing is they're totally bound up in paperwork that they shouldn't be doing.
Yeah. Well, we talked about this earlier, but, when you look at the crime stats, they're actually continuing to fall. And we get through our letterbox the paper from the local constabulary, and they were trumpeting the fact they'd caught a shoplifter. One.
So I don't believe this. I think that there are all sorts of things that police forces have done in order to massage their crime figures down. And I think one of them isn't that if someone if someone commits 50 burglaries, they report it as one crime. If it's an individual, there's stuff that they do to basically distort the figures.
Really?
So I simply don't believe, and the stories you hear of me mentioning shoplifters, people going into Tesco, city centre to Tesco or Sainsbury's or whatever, taking what they want and walking out because the staff have been instructed not to stop them. Yeah. And the police don't care. It's appalling.
Yeah. No, well, I've seen that in action, and I paid, but if you're just bold as brass, you go out and just nick stuff, then you can get away with it. But when you look at victim reported crime, that's also falling. So
I just don't believe. I think people don't report it. I simply don't believe these stats, Keith.
Right. Fraud is massively on the rise. So, beware.
Yeah.
And looking at the Crown Court system, well, we're not doing well there either. Criminals, once they go into the system, the few of them that get caught, well, they get stuck there. And the number of cases that have been delayed for more than 2 years is growing, in part because we haven't recruited any magistrates. The prison population, though, is going through the roof.
Is that because there have been fewer crimes committed, Keith?
I've no idea, actually. So it implies that few people who go through the court system these days get a decent sentence.
Yeah, it also implies that all the crimes, the few crimes that are committed these days are all serious.
Yeah. It's the only ones they bother investigating, probably.
Yeah.
So the prisons are increasingly crowded. That increase in the prison population means that we haven't built any more prisons. We're just sticking more people into them. But despite the growing prison population, there are fewer prison officers to look after them. So the few that are left are stressed.
Can I just say that is an improvement in productivity, Keith?
It is, absolutely. Just keep them locked in their cells 23 hours a day. Meanwhile, taxation at its highest in 70 years, and Richard's favorite chart is forecast to keep going. So all that means we're not doing well. You know, when it comes to like value for money, we are spending a hell of a lot, but UK public services don't seem to be doing terribly well. And I wrote this last week. Next week, the Chancellor appears set to cut income taxes rather than, you know, pay the junior doctors. Frankly, that fall in junior doctors' real pay, I thought was shocking. You know, how can we expect them to work really hard?
Yeah, it's vindictive.
Yeah, when we're not, you know, we're not appreciating them. Basically,
it's just vindictive. It's unpleasant. I don't know where it's come from, but it's just unpleasant. And the government propaganda that come out with the junior doctors' pay strike has been disgraceful. You know, it's just appalling.
Back to our usual schedule, inflation watch. We've had now October inflation numbers for most of the world, and they've been great, actually. Inflation has undershot everywhere.
Yeah.
But if we look at trueflation in the US, it has bottomed and it's kind of heading in the wrong way, actually. So unless the Fed manages to slow the economy further, US inflation does not look like it's sustainably heading towards the 2% target. The good news is the UK trueflation is falling very rapidly, down to 4.8%, still very high, but that's a good-looking trend. Food inflation continues to fall. Normally, when you have a sharp fall in inflation, you have a recession because you've had to raise interest rates. So far, this is the largest fall in inflation in the US without a recession. Can the US escape a recession? Question mark. So bottom line, inflation's falling everywhere, but trueflation in the US is not heading towards the 2% target. It's heading in the opposite direction, suggesting the battle is far from won and interest rates are going to have to stay high for longer until that reverses. Yep. Recession watch, Richard.
Thank you, Keith. So no sign of any recession bar yet. And are we going to get a soft landing? I mean, I think we're not going to get a soft landing, but I may be wrong.
Yeah, but everyone's talking about soft landing.
Yeah. We do occasionally get soft landings, but they're quite unusual. And the mid-1990s remains the only clear-cut soft landing.
Yeah. Every other time we've had a recession.
Yeah.
And we've had a very, when you look at the rise in interest rates this time, it's a very rapid rise compared to history. Yeah. It would be unusual not to get a recession. And frankly, we've been calling for a recession for ages and it hasn't happened. But
so tightening credit conditions tend to lead loan growth by 4 quarters. So we've got very much tightened credit conditions. Loan growth hasn't really declined that far. That it's not moved on to into the negative area. So that suggests that we've got further to go in terms of loan growth or loan contraction.
Yeah.
The BEA's credit card data suggests the US consumer has begun to seriously cut back on their expenditure. Interesting.
Yeah, I'm not sure whether to believe this. This is quite a big drop.
Yeah. Well, we'll see where we go. I would suggest discretionary expenditure is falling fast, and the US consumer is living beyond their means. The savings rate is the lowest since the GFC, and that means that effectively they are tapping themselves out. US economic confidence. So look at the composite is not great, and
yeah.
On a fairly sort of significant downward path, I think. Husband Strategic Advisor's employment-based recession indicator is flashing red. It is moving up sharply higher.
Yeah, so the only indicator which really showing that the US is getting close to a recession is continued unemployment.
Yeah. Global Global supply chain conditions are improving, which suggests that there are one consequence of this is, well, not a consequence, one of the precursors of this is going to be that there's actually fewer goods moving.
Yeah.
And that is a fairly significant fall from that very high peak. So that's looking pretty slow. And the breadth of job gains declined to the lowest level since 2020. But recessions in the grey bars here, it needs to be substantially lower than the sort of 50 point the index is currently at.
Yeah.
US small businesses employment is continuing to fall, but it's not down at the recessionary levels.
Well, yeah, it's below 100, but it's been below 100 for most of the year, and employment in the US has kept on rising.
Yeah. And the ability to pay for an unexpected $2,000 expense, those who can pay, is falling. I mean, it's what's the range is sort of 66 to 70%, and it's currently 64%. So it's a little bit, has dropped a bit. US Philadelphia Fed Constant Diffusion Index of 50 states, with the blue line showing the 1 month, 3 month in red, is falling fast, and those sort of rapid declines tend to coincide with recessions.
Yeah.
A lot of indicators suggesting that recession is imminent.
Yes, that's right. But actually, not much sign of it in the employment data, frankly, is the bottom line. And the diffusion index, reminder, it simply looks at whether economic statistics are rising or falling. It doesn't say. So if the one state records, let's say, a rise in activity of 10%, and another state has a fall of activity of 0.1%, then it'd simply be +1 - 1 equals 0. So it's, does not account for the magnitude of the changes in different economic indicators.
Yeah, right.
But as Richard has just said, this does seem to have very good predictive power, or like when I say predictive, like coincident power. When you have these big falls, historically, that has tended to coincide with a recession. But the reality is we're not seeing that backed up by the real-time employment data, for example.
German construction industry is in deep recession, and that's like it's still heading downwards. Japanese GDP fell by 0.5% in Q3, which is a lot worse than expectations.
Yeah.
Watch this space, really.
So Japan is already in recession.
So we've got continuing forecasts of recession. US appears to be slowing. I mean, I think the data is slowly suggesting that the developed world is moving into a recession, but it's very slow, and it's very sort of partial data.
Yeah.
More data is beginning to emerge, suggesting that a recession is on its way. The economies are slowing down. Yeah,
I'm just not sure though, Richard. I mean, I completely agree. The leading data, and actually the coincident data now, is suggesting that. But when you look at the most important thing is employment, and unemployment is not rising in the US.
The US property market is starting to roll over, I think. But I reckon we'll know within 3 months. I think we'll start seeing.
Okay, and on to soft landing watch. So we've talked previously about the effect of rising interest rates on corporate solvency and the need to refinance debts, particularly of highly indebted companies. Well, the reality is they all locked in a lot of cheap debt during the pandemic, and most of that doesn't need to be refinanced until 2025 and onwards. So there is no immediate stress for a lot of highly indebted companies. And as a result, corporate bond spreads are not signaling any concerns about rising default rates. The bond market doesn't think that we're going to have a recession in which there are going to be lots of corporate defaults. And if we look at the Lightcast website, well, they're saying that over the last month, job postings actually increased by 11% month on month, though down 30% from the last year. So they're saying, actually, the US economy is improving in terms of job postings. However, I wanted to double check that. So I looked at the Indeed website, and they are not showing that at all. And frankly, this looks much more like what I'd expect. They are showing that the US jobs market continues to slow, but is doing so very slowly. The UK numbers are interesting. So the UK has slowed faster than the US, which is what we're expecting, and is continuing to deteriorate, but is still above pre-pandemic levels. So the UK jobs market remains tight, but it is slowing. Now, these are interesting. Taiwanese export orders have been rising to the US as well. So we know that the Korea, Taiwan, their export orders are a good indicator of how the global economy is doing. And that these seem to say the global economy actually may have hit a low. And the financial stress index is basically saying there's no financial stress. Now, this is construction spending in the US, in particular manufacturing construction spending. And you'll see how the CHIPS and the IRA acts have really supported construction spending. And that's going to be ongoing, although it does appear to have hit a peak. So bottom line is the market really believes in a soft landing. And thus far, economic slowdowns have been mild and well ordered. And you get a recession when a feedback loop starts to kick in. So, people lose their jobs, they cut spending, and you get a rapidly evolving downturn. And we have seen none of that yet. And the linear models that for example, the OBR uses, and the OBR is forecasting that unemployment in the UK will rise, but we're not going to get a recession. I don't see how those two are compatible. And onto other charts, Richard.
Thank you, Keith. So venture capitalists are still a long way from properly marketing their portfolios to market. Secondary pricing levels have not found a bottom. So the question really is what are the embedded losses in VC portfolios that need to come out? And the suspicion is a little bit like the embedded loss in SoftBank of owning shares in WeWork.
Yes, exactly.
And the World Happiness Report shows the UK is below Czechia, but better than France.
Yeah.
But we're a long way from the top.
Finland, Denmark, it's all the Icelandic countries. I thought they're all depressed and, had very high levels of alcoholism, those countries, but apparently not. Apparently they liked, drinking vodka long evenings.
It's the Northern European countries, isn't it?
Yeah.
Maybe we should emigrate, Keith.
I think we are a Northern European country, actually.
We're in Scotland.
Yes.
US EV penetration continuing to rise.
9.7% of total vehicles, not huge, but growing at 63% a year.
Yeah. So these are companies that SoftBank has IPO'd. So if SoftBank IPOs a company, steer well clear of it. And steer well clear of SoftBank as well.
Well, absolutely. Yeah. And actually here, we've got WeWork and saying the shares down 60 odd percent. Well, we know they're down 100%. And on to good news. And this is a wind farm in Portugal. And last month, Portugal had windy weather conditions. And for 5 days, starting from the 27th of October, all of the country's electricity was renewable. In fact, they produced so much renewable energy that for 95 hours during that period, they not only provided all their own electricity, but they exported electricity to Spain. Now, the flip side of that is that during that period, consumer energy bills dropped to near zero. Now, so if you're an energy producer, is that good? We ask ourselves. if you're an investor in wind farms and you produce 100% of the energy and you get nothing for it, that's not good, is it?
No.
So anyway, good news for the consumer, I think, is what we'll say on that front.
Good news for the planet.
And onto equities, Richard.
Thank you, Keith. So the World Equity Index was up 4.6% for the week, with that big rise in the Nasdaq, particularly important, as Keith pointed out.
Yeah, amazing.
Yeah.
Given the rise in interest rates, I was forecasting that equities had a really bad year, and I've been totally wrong.
Yeah, me too. And the FTSE All-Share Index was up 0.7%, which goes to show that the FTSE doesn't count.
Yeah.
The Euro stocks are up 2.2%, which baffles me because I don't think that that is justified. But
yeah, now we've seen the Eurozone is already in recession.
Yeah,
interest rates are high. How come the European equities are doing all right? Mystifying.
S&P 500 up 5% on the week, nearly 20% for the year.
Yeah, so actually that's 5% over the last 2 weeks since we last reported, but still, amazing, close to the highs for the year.
And Nasdaq up 5.5% for those 2 weeks and up 36% for the year. Oh, if only, If only. Russell 2000 up 6.5%, but pretty much unchanged on the year.
Yeah.
So everybody's projecting the US economy is going to fire away into orbit.
Yeah.
The Hang is saying up 2%.
Yeah, down 11% on the year.
Yeah. And the Topic's up 2% and up 26% on the year. Mind you, the currency has gone the opposite direction. Bitcoin up a little bit and up 126% on the year, which is
yeah.
And the pound against the dollar at 1.25, which is sort of middle of its yearly range, really. And the euro against the dollar is actually basically the same, 1.09, in the middle of its yearly range. The dollar index is falling back down. It's quite sort of sinusoidal, isn't it? It looks like it's probably heading back down to closer to 100.
Yeah.
Nothing very remarkable, though, I think.
Well, I think what happened was the weak US inflation numbers convinced the market the Fed had stopped raising, and then the dollar index declined.
Yeah. And the VIX is obviously, as a consequence of that, has fallen hard, 16% down a week, 40%.
Amazing. Absolutely amazing.
And recent equity market rally has been extraordinary, and it would be a record-breaking bear market rally if it turns out to have been that.
Yeah.
And it's come without taking into account the record number of downgrades, the S&P 500 corporate debt, which is like...
Yeah. Yeah, so the equity market is off to the races. But in the meantime, debt downgrades, earnings downgrades.
Mind you, as you said, Keith, all of it is due to the Magnificent Seven, isn't it?
Yeah. But,
so if you took out the Magnificent Seven and then just had 500, the S&P 500 without them, the picture would be entirely different.
No, but you've seen that the Russell 2000's up like 6% over the last couple of weeks, but earnings are being downgraded. How does that work?
And we've got falling quarter 4 earning forecasts, which just shows what Keith just said, and that suggests that, well, profitability is expected to drop as share prices rise.
Yeah.
And equities are still expensive relative to bonds, particularly the Magnificent Seven up there on the top right-hand corner.
Yeah.
Equities had a strong week because there was a big short squeeze. And that was a very big short squeeze.
Yeah. So essentially, funds went from being short to being long in a very brief period.
Yeah. And in the 10 days to Friday 17th, $10 billion of US equities were purchased, most ever.
70 billion, mate.
Yeah, 70. $70 billion were purchased in US equities, the most ever in a rolling 10-day period. And hedge funds have gone big tech. big on big tech.
Yeah.
We all know where that leads, don't we? And rising interest rates are most affecting the emerging market equities, but not really affecting developed markets.
Yeah.
And the market is expecting earnings growth to resume next year.
Yeah. I thought this was a really interesting chart.
This is the expectation that there isn't going to be a recession, isn't it?
Precisely. And actually, they're going to have very strong earnings growth.
Yeah.
At some stage, surely this coincides with reality, smashes into reality. But so far, equity markets just off to the races. Amazing.
Yeah. And the ratio of the Nasdaq to small caps hit a new record high. So yeah, you don't want to be in small caps. You want to be in the Nasdaq, or
yeah. So I mean, again, this would have been something I got completely wrong. I was expecting rising interest rates to make tech less attractive, and not happened at all.
And this is the assets of major central banks, and the S&P index followed it up faithfully and isn't following it down.
Yeah.
Equities tend to bottom after the Fed starts cutting rates, and obviously it hasn't started to cut rates yet.
Yeah. Basically, the Fed starts cutting rates in reaction to an economic slowdown.
Yeah.
And we ain't had an economic slowdown, so, equity's doing all right.
Yep.
On to commodities. Thank you, Richard. So, reminder that we've been through a long period now of commodity underinvestment. So, going forward, might expect that to lead to undersupply, and lots of commentators saying that we're still in the super cycle and commodities should do well over the coming years. And onto energy commodities. So Brent bounced a bit, up 1.5%, but is actually down 5.3% year to date. Who would have thunk it? So earlier in the year, we were forecasting that the oil market would be in deficit by over 2 million barrels a day in Q4. Well, we're in Q4, and oil prices have actually fallen sharply. The other thing that happened this week was that OPEC Plus were due to meet, and they have postponed their meeting to this weekend, which suggests some tension within OPEC Plus. And the danger is that currently the oil market is being kept in balance by Saudi and Russia, keeping barrels off the market. But the Saudis appear to be getting frustrated with the fact that they're the only ones doing the heavy lifting and nobody else is contributing cuts. So there is a possibility that the whole OPEC Plus deal falls apart and Saudi starts pumping again to teach everyone else a lesson, in which case oil prices would collapse. Watch this space. WTI up 0.7% on the week, but still down 5% on the year. Numbers specific to the oil market. Well, over the past 2 weeks, we've had a build of 5.6 million barrels in the US. So the US oil market is well supplied. Production is at the high of 13.2 million barrels a day. And the Baker Hughes rig count ticked up by 4. And if we look at US oil production, you can see that it is now dominated by shale. When we look at the main basins in the biggest shale play, the Permian, you can see that productivity has peaked, and actually peaked quite a long time ago. So earlier in the year, was it last year, we talked about predictions that US shale production would peak quite soon because the best areas of all the main shale basins had been drilled out, and now they were starting to drill the peripheral areas with less hydrocarbons, and therefore productivity drop. And these charts show that that is occurring. This is the productivity per lateral length of horizontal drilling. But as Simon W. on our Discord makes clear, the whole shale revolution is one of technology. And again, shale drillers have managed to offset that decline by massively increasing the length of the laterals they are drilling, and they're using more proppant to keep the cracks open. As a result, the current levels of drilling are enough to not only keep production at a high, you're looking at the bottom chart here, so production from the Delaware and Midland, where productivity is falling, is at an all-time high, but just keeping the current number of rigs in operation is enough to grow it to 6 million barrels a day by 2027. So they've cut the number of rigs, that's the top chart, but they're still going production. Amazing, because they're drilling longer laterals, and they're getting keeping those cracks open for longer using more proppant. Okay, turning to natural gas. Well, we're having a mild winter so far, and EU natural gas futures fell 2.7%, down 39% on the year. UK also fell, down 0.7%, down a third year to date. All good news. US natural gas futures fell 5% over the last couple of weeks, down 35% year to date. Coal continues to decline, down another 0.7%, down 69% year to date. Uranium, Richard will be happy, up 11.5% over the last 2 weeks to a new high for the year, up almost 70% year to date. Skip that. I've got a section on that next week, Richard. On to industrial metals, Richard.
Thanks, Keith. So aluminium unchanged, cobalt unchanged forever.
Yeah.
We don't really know what's going on. Copper up 4% on the week.
Yeah, doing well, but still down 1% on the year.
Yeah, probably due to a little bit more economic confidence around. Chromium is a little bit down on the week. I don't know where's iron ore. Iron ore is continuing to go up significantly, 6.3% in the period, and up nearly 16% year to date. So yeah, iron ore is back in demand.
Yeah, and that's all on expectations of Chinese infrastructure spending.
Yeah, lithium is continuing its decline. A big drop, actually, 13% over the last 2 weeks.
Yeah, 75% drop on the year. Wow.
Neodymium down 4% for the week, down 35% for the year. And nickel continuing its descent, down 6.8% for the week, now down nearly 50% for the year. Tin pretty much unchanged from the week and the year. Ferrovanadium a little bit down on the week, down 30% on the year. You might expect to see that go back up if Chinese steel manufacturing is increasing.
Yeah, why don't they mandate vanadium to be used in all steel? Because it's vanadium's cheap, and it 1% doubles the strength of steel. You can just use a lot less steel.
Yeah, I completely agree. Zinc down 2% on the week, down 14% on the year. And precious metals, gold up 2% over the period, up 10%, 9% year to date. Good run for gold and silver over the last couple of weeks, 4 weeks or so. Silver up 4% over the period and marginally down 1.3% on the year. Platinum up nearly 7% on the week, actually. Rhodium down 3% on the week and down 65% nearly on the year.
Yeah. During the week, I met one of our viewers, Matthias, who's over from Germany for lunch, and he was at a mining conference in London, and he was saying that he'd been to a mining conference in South Africa earlier in the year, and it was like a graveyard because they're all, it's PGM, Platinum Group Metals in South Africa. And, you look at this chart, a couple of years ago, they were all making hay, but
Yeah, no, they're
rhodium
not.
looks dead as a dodo.
Yeah, it does, doesn't it? Palladium also looking pretty dead, or up 7% on the week, down 41% for the year, and a continuing downtrend. So,
Okay, thank you, Richard. On to rates. And so good news is over the course of the last month, the whole UK yield curve has shifted down substantially. And we showed you earlier how UK inflation has come in weak. And, earlier in the year, inflation expectations were much higher than they are now. And you would have expected UK rates to therefore have fallen over the last 6 months, but they've risen. This is the US, and again, rates have come down over the last month. Inflation has come in weak, and normally at the end of the Fed tightening cycle, bonds tend to do better than stocks. So far, that has not played out. Early days. And unemployment in the US is rising. And again, that tends to favor bonds over stocks. But again, not happening. Now, this is a very, very long-term chart of interest rates. And they've been trending down over the course of centuries. I expect that trend to reassert itself. So far, I've been wrong. And in the US, the maintaining very high interest rates while inflation has been falling means that finally the US monetary policy has caught up with the Taylor rule. So monetary policy in the US is appropriate for the first time in 3 years. And the rise in real interest rates in the US over the last few years has been absolutely extraordinary. Fund managers are very keen on bonds. Let's hope they're right. So this is the UK 2-year. So had a good couple of months. But Jeremy Hunt undid quite a lot of the work in the last few days. 10-year, the same. 30-year, this is a big move. Idiot. This is US 10-year, you'll see, it's ticked back up, but nowhere near to the same extent. The moves in the UK yields are entirely due to increased gilt issuance upsetting the market. German 10-year ticked up a bit. Italian also up a bit the last few days. Now, Moody's have actually reaffirmed Italy's investment grade status and improved its outlook from stable to neutral. So that was good news for Italian bondholders. Greek 10-year up a bit. Any change to your views, Richard?
No changes. How about you, Keith?
No. Concluding comments. Well, so it's been 2 weeks. We've had a lot of economic data. The data on inflation was universally good news. They all missed to the downside. And in the case of the UK, by a substantial amount. The bad news is that wage growth everywhere remains far too high to be compatible with a 2% target. And there is still some way to go. So that means interest rates are going to have to stay higher for longer until they start having an effect and creating some slack in labour markets. Despite all that, equity markets have had an extraordinary bounce over the last couple of weeks, despite rising corporate debt downgrades and falling earnings expectations, both of which would expect it to be bad for the equity market. But market doesn't care. The usual end of the year rally is on. Richard, how have you been over the last couple of weeks?
So I've done nothing, Keith. I am actually quite bullish on gold.
Good.
So I'm and my uranium Shares in uranium and commodities are actually, they're sort of doing okay. So I am, it's a very long-term, slightly painful process, but I'm just sitting where I am. Yeah. How about yourself, Keith?
Thank you, Richard. Well, I had an indifferent couple of weeks, actually, up 0.3%. The bottom line is I was doing okay until, the mini budget in the autumn statement. I was up for another 5%, clawing it all back. And then Jeremy Hunt steps up, spends just an irresponsible autumn statement to me. Is that it's jam now, paying for it later. It's like a political calculation to stiff the incoming Labour government, as far as I could see. So gilt sold off, selling off today. This is going to be worse next week. But, I really need recession to bail me out. And I've been forecasting a recession for a long time now. But the flip side of all this is that I'm getting a real yield of 4.5%, pretty much tax-free. And actually, I was thinking about this. I've lost a lot of money and not looking very clever. Every week I have to talk about how wrong I've been, which is not, I don't enjoy personally. I quite enjoy it when I'm up and telling everyone my godlike prescience about the markets. That has largely disappeared this year. But 4.5% real yield, don't really have any worries. So, I can afford to sit and wait until this trade comes good. And I'm still convinced it will do, actually, because, the reality is that interest rates are going to stay high and eventually they affect the economy. Now, so far, it's taken much, much longer than I've expected. But, every month in the UK, we have more and more households having to refinance their mortgages onto new higher interest rates, and that sucks demand out of the economy. Construction sector is slowing, manufacturing is in recession. So eventually the economy slows.
Yeah, I think you're right. It's just a painful process.
Yeah. Okay. That is it. Thank you for your forbearance. And we missed a week as I was off hiking in the Lake District, and normal service will be continued next week. In the meantime, please can you press like and subscribe to the channel. And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.